After studying this module, you shall be able to understand the process of issuing commercial paper, who can issue and invest in a commercial paper, analyze certificate of deposits as a market rate, instrument, terms and conditions with respect to its yield, secondary market and liquidity. Comprehend the market for commercial bills in India, interest rate and process of bill discounting. Understand the difference between the three money market instruments, viz. Commercial paper, certificate of deposit and bill of exchange. The commercial paper, certificate of deposit and commercial bill are three popular money market instruments which are usually issued for a time period ranging from 7 days to 1 year. There is big difference between them on basis of yield offered by them. The issuers of these instruments and the safety and liquidity associated with these instruments. The next three sections we shall discuss about these aspects of the instruments in detail. So, the first one is, what is commercial paper? Introduced in the Indian money market in 1990, commercial papers have emerged as an alternate short-term investment instrument for the issuing corporates, financial institutions and the primary dealers. They are like unsecured promissory notes similar to the T-bills, and like all other money market instruments, they are issued at a discount to their face value. Over a period of time, they have gained importance as an indispensable tool to raise short-term capital for the corporates. These CPs can be issued in two forms. Number one, a promissory note, or in a dematerialized form through any of the depositors approved by and registered with SEBI. Banks, financial institutions and primary dealers are permitted to hold the CPs only in dematerialized form. The second one is that of issuers and potential investors. The question is, who can issue? Firms with tangible net worth as per the latest audited balance sheet not less than rupees 4 crore are permitted to issue a CP. Further, the company must have sanctioned working capital limit issued by the banks or all India financial institutions, and its borrowing account should be classified as a standard asset by the financing bank, ensuring good creditworthiness of the firm. Commercial papers were introduced in India in 1990 so as to enable highly rated corporate borrowers to diversify their sources of short-term borrowings. Simultaneously, it provides additional safe short-term investment instrument to the investors. Subsequently, primary dealers and all India financial institutions were also permitted to issue CP to enable them to meet their short-term funding requirements for their operations. Then credit rating. All eligible participants are required to obtain credit rating of the commercial papers they intend to issue. This credit rating can be done by any credit rating agency in India, viz. CRISIL, ICRA, CARE or Fitch Rating Company, or any other similar credit rating agency specified by Reserve Bank of India from time to time. The statutory requirement for issue of commercial paper by a firm that the instrument must obtain a minimum credit rating of A2 as per the rating symbol and definition prescribed by Security and Exchange Board of India, that is SEBI, in order to raise funds from the market. The rating must be recent and not due for any kind of review by the rating agency. In other words, it must be a valid rating. The amount to be raised via CP must be limited to either the limit decided by the company's board of directors or the one for which rating has been done by a credit rating agency, whichever is lower. The potential investors. A wide variety of entities are permitted to make investment in the commercial paper, with mandatory requirement of high credit rating. Potential risk is relatively less. Hence, individuals, banks, corporates, registered or uncorporated in India, and the unincorporated bodies, non-resident Indians, and foreign institutional investors, etc., are permitted to invest in the CPs. However, Securities and Exchange Board of India decides on the ceiling for investment by the foreign institutional investors. Minimum denomination or maturity. The minimum subscription for investment in a commercial paper is rupees 5 lakh or multiples thereof. Similarly, they can be issued for maturities in a range of 7 days up to 1 year from the date of issue. However, the maturity date should be within the validity of credit rating of the instrument. Further, CP may be issued on one day itself, or it may be issued in different parts on different dates, provided maturity date is same for a particular commercial paper. Every issue of commercial paper, even if it is a renewal, has to be considered as a fresh issue. There are certain examples. For example, if a firm sold goods worth rupees 25 lakh on credit for a period of 3 months. Meanwhile, during these 3 months, the firm requires money for purchase of an essential raw material immediately. In such a situation, the company can issue commercial papers in the form of unsecured promissory notes at discount of 10% on the face value of rupees 25 lakhs with a maturity of 90 days. If the credit rating of the instrument is strong, it would be able to find investors easily, and the investor shall earn rupees 61,643 in the form of interest. Issue of commercial paper serves twin purpose of providing liquidity to the corporate and a good short-term investment opportunity for the potential investors. Interest rate and return, yield and safety. The interest rates offered by commercial paper are higher than that on the T-bills, since they are relatively less secure in comparison to the T-bills. Even though high credit rating ensures that chances of default are minimal, but they are not zero risk instruments. Since commercial paper are not backed by any collateral, only firms with high quality credit ratings will be able to raise money through this instrument. Commercial papers provide flexibility in raising working capital resources at market determined rates whenever required by the firm. Now we can discuss about the secondary market, liquidity and transferability of the instrument. CPs are actively traded in the secondary market. The simple process of being freely transferable in demat form make the instruments more attractive. The effective yield is decided on basis of going interest rates in the market. However, all such transactions are required to be reported on FIMMDA platform within 15 minutes of the trade for dissemination of trade information to market participation, thereby ensuring market transparency. There are certain commercial papers issued by companies in India at their face value. These can be observed from this table. There are certain certificate of deposit. Now the question is, what are certificate of deposits? A certificate of deposit is a negotiable money market instrument issued by banks and select financial institutions in the lieu of funds deposited for specific period of time. Similar to commercial papers, they are issued in the form of promissory notes at a discount to the face value. In India, the CDs can be issued by the commercial banks and financial institutions like IFCI. Certificate of deposits or CDs are governed by the Reserve Bank of India guidelines as amended from time to time. The banks or the financial institutions should issue the CDs only in the dematerialized form. There are issuers and potential investors, and we can discuss about their eligibility conditions. The issue of CDs is confined to few commercial banks and financial institutions like IFCI. Banks have been given the freedom to raise money using CDs based on their requirement of funds, and financial institution can issue CD within the overall umbrella limit prescribed by the Master Circular on Resource Raising Norms for the financial institutions issued by Reserve Bank of India and updated from time to time. Similar to other deposits, banks are required to maintain the cash reserve requirement or CRR and the statutory liquidity requirements or SLR on the issue of CDs too. The potential investors, companies, individuals, trusts, funds, banks, and even NRIs are permitted to make investment in the CDs. However, NRIs are not allowed to repatriate the maturity amount and they cannot be endorsed to another NRI. Now let us look at the minimum denomination and maturity. The minimum amount permitted for investment in a certificate of deposit is rupees 1 lakh and in multiples of rupees 1 lakh thereafter. And the maturity period varies from minimum of 7 days to a year in case of banks and from 1 year to 3 years in case of financial institution. Both banks and financial institutions are advised to maintain a registered record of the CDs issued with all the important particulars. If the maturity date happens to be a holiday, the issuing bank or the financial institution, they are advised to make the payment on the immediate preceding working day. Hence, it is recommended that the time period of the deposits must be decided such that the date of maturity does not coincide with a holiday. Banks have not been given the privilege of any grace period for repayment of the CDs. The certificate issued on making deposit under the CD bears all the essential details like amount, date of investment and the date of maturity. The last holder has to present the CD for repayment on the due date. Unlike fixed deposits, an investor cannot apply for a loan against certificates of the deposits. There are certain issues on interest rate and return, yield and safety. Now first discuss about the interest rate and return. The returns offered by banks on CDs tends to be higher than the T-bills, but comparable with the commercial paper. The reason being that certificate of deposits bear relatively higher risk than T-bills. The return offered on CDs may be presented in the form of either annual percentage yield or the APY or annual percentage rate or the APR. Since in APY the interest earned is paid on basis of interest calculation, however, the APR method calculates return on basis of simple interest only. The difference between the two is reflected only if the interest is paid more than once in a year, and in such a situation APY is considered better than APR. Usually CDs only offer a difference between the purchase price and the redemption price, that is the face value, and interest rate or return needs to be calculated. On maturity, buyers receive certain amount in addition to the principal amount. Unlike the traditional deposits, the amount and return offered on CDs is often negotiable. Banks do not permit premature withdrawal of money deposited under the CD, or even if they allow, heavy penalty is imposed in the form of lower interest rate or reduction in the interest earned over 6 months to discourage such withdrawal. As a result, return offered on CD is usually higher than that offered on fixed deposit, since large amount of money is committed to stay with the bank for a fixed period of time, which helps banks plan its asset liability mismatch better. And there are secondary markets and liquidity. The process of transfer of CDs is very simple and similar to that of the commercial paper. The CDs issued in physical form are transferred by a simple process of endorsement and delivery. The ones held in demat form are transferred by the simple procedure of debit and credit of respective demat accounts. This makes the CDs very liquid instruments in order to avoid tampering and fraud with physical form of the CDs. Banks print them on good quality security paper and to get it signed by 2 or more authorized signatories. Banks, the financial institutions, also maintain a register of CDs issued with complete particulars. Reporting. Banks should include the amount of CDs in the fortnightly return under section 42 of the RBI Act 1934 and also separately indicate the amount so included by way of a footnote in the return. Further, banks, financial institutions should report the data on issuance of CDs on the web-based module under the online returns filing system, that is ORFS, within 10 days from the end of the fortnight to which it pertains. All OTC trades in CDs shall be reported within 15 minutes of the trade on the FIMMDA reporting platform. Settlement. All OTC trades in CDs shall necessarily be cleared and settled under DVP-1 mechanism through the authorized clearing houses, that is National Securities Clearing Corporation Limited or NSCCL, Indian Clearing Corporation Limited or ICCL, and MCX Stock Exchange Clearing Corporation Limited or CCL of the stock exchanges. Now there are certain advantages of certificate of deposit as a money market instrument. These are: the CDs are considered relatively safer since the returns are known beforehand. Return in CDs are more as compared to that in saving account and a fixed deposit. CDs help the banks in managing their assets and liability mismatch better since the sum is insured for a certain fixed period of time. We can also discuss about the disadvantages of certificate of deposit as a money market instrument. The returns are relatively less as compared to other avenues of investment. Secondly, the money is tied up along with the long maturity period of certificate of deposit. Huge penalties are paid if one gets out of it before maturity. Now let us discuss about commercial bill. The question is, what is a commercial bill? A bill of exchange is also known as commercial bill or a trade bill. A bill of exchange is an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument for the value of goods or services delivered by him. The maker of the bill of the exchange is called the drawer and the person directed to pay is the drawee. The person named in the instrument to whom or to whose order the money is to be paid is called the payee. At times, the drawer and payee may be the same entity. It is a negotiable instrument which can be further negotiated by means of endorsement and is payable on demand side or after a specified period of time, that is usance bill. Example of bills of exchange can be discussed over here. Let us suppose XYZ computer supplies 100 computers at rate of rupees 50,000 each to the Messrs Popular Creation Limited. Messrs Popular Creations expresses its inability to pay immediately and expresses its wish to purchase on credit of 90 days. In such a situation, XYZ Computers draws a bill of exchange of 90 days maturity on Messrs Popular Creations. XYZ Computers, that is a sellers, has assumed the role of a creditor and is called the drawer of the bill. The drawer sends to the bill to Messrs Popular Creation, that is buyer and drawee of the bill, who acknowledges to pay the amount of the bill 90 days after the receipt of the goods by writing his acceptance on the bill along with signatures of the concerned authority. The acceptor of the bill could be the buyer himself or any third party who is willing to take the risk of paying the bill on maturity if the buyer defaults in doing so. Now we can discuss about certain kinds of bills. Bills of exchange can be classified on different bases. Based upon maturity date of the bill, it can be classified as demand bill, a bill which has to be paid immediately at sight on presentment to the drawee is called the demand bill. This implies that the payment has to be made immediately on presentment of the bill to the drawee. This can also be a usance bill. When a particular credit period is granted to the drawee for making the payment of the bill, it is classified as the usance bill and time period is called usance. 3 days of grace are granted to the drawee for making payment. On basis of documents attached with the bill, it can be classified as a clean bill, a bill which is not accompanied with any supporting document such as railway receipts or lorry receipts, etc., which are evidence of an actual trade transactions, is classified as a clean bill. Then there can be documentary bill, a bill accompanied with documents which confirm trading of goods, services has taken place amongst the parties to bill is classified as documentary bill. The supporting documents may be railway receipt, lorry receipt, bill of lading, etc. On the basis of consideration given to the drawee, the bills can be classified as trade bills, that is a bill which is written and accepted after selling and buying of goods or services is termed as trade bill. Here, the seller writes a bill which is accepted by the buyer. Since the basis of this bill is trading activity, therefore it is called a trade bill. They are drawn for trade purposes against proper consideration. These bills are proof of debt and the drawer can resort to legal action to obtain the debt from dry. Then there are accommodation bills. An accommodation bill is one which is drawn and accepted only to provide financial help to some party. It is drawn and accepted without any consideration and there is no genuine trade transaction involved in it. So a bill drawn and accepted only to provide financial help to some party and not for genuine trade transaction is termed as an accommodation bill. Since there is no consideration involved in these bills and they are not a proof of debt, legal action cannot be resorted for recovery of amounts against these bills by the immediate parties. Now we can discuss about minimum denomination and maturity. These bills are of 30 days, 60 days or 90 days maturity. There is no minimum maximum denomination of this type of bill. The value of the goods is the denomination of the bill. In case of the immediate requirement of funds by the drawer, that is before the maturity of the bill, it may be discounted by a bank or financial intermediary. The interest rate and return, yield and safety on these types of bills. Usually the yield on commercial bill is higher than that on other money market instruments like T-bill, commercial paper or certificate of deposit. The yield on commercial bill varies according to the credit worthiness of the drawer and the drawee. A bill issued by a AAA rated company should be discounted at a lower interest rate as compared to that of an A rated company. A higher yield acts as compensation for investors who choose the higher risk commercial bills. A higher interest rate is charged on a clean bill as compared to an accommodation bill. In general, there are two bills with the same maturity. The bill with lower credit quality will offer a higher yield to investors to compensate them for the higher amount of risk undertaken. Lower rating implies relatively lower chance of creditor being unable to meet its debt obligation. Now let us discuss about discounting of bill of exchange. After the acceptance of the bill, the drawer has the option of either to wait for the maturity of the bill, that is 90 days after the receipt of goods and services, to receive the payment from the buyer on maturity of the bill. Alternatively, he can approach a bank or a financial institution for discounting of the bill and obtain payment immediately. In such a situation, the seller shall endorse the bill in favor of the finance company and in turn the financing company shall discount the maturity value of the bill at going market interest rate and give the discounted value of the drawer. The process is called discounting of the bill. On the maturity date, drawee shall pay the face value of the bill, that is the maturity amount, to the finance company and complete the transaction. Now there are certain examples of discounting bill. In this example, we assume XYZ Computers approaches Messrs Fair Finance Company FFC for discounting of the bill for 90 days. FFC agrees to discount the bill at 10% per annum. The amount received by XYZ Computers after discounting shall be calculated as 100 multiplied by 50,000 multiplied by 100 multiplied by 90 divided by 365 multiplied by 100, which will be equal to 1 lakh 23,288. So, XYZ computers shall receive rupees 50 lakh minus rupees 1 lakh 23,288 is equal to 48 lakhs 76,712 by discounting the bill. The FFC shall get the full amount of rupees 50 lakh from the drawee on the date of maturity of the bill. The bill of exchange, commercial bill, may be issued by any supplier of goods or services who may be any individual, firm, corporate entity of any size. The bill is issued on the buyer or the drawee of the bill for the value of goods and services delivered to him. He accepts the bill and promises to make the payment after the specified period of time. Now, there is a question of rediscounting of bills. The bills of exchange discounted by banks can be rediscounted with other scheduled banks and specified financial institutions. Such institutions can further rediscount such rediscounted bills. It was expected that rediscounting of bills should encourage establishment of an active bill discount market in India. Rediscounting of bills also helps in utilization of funds laying idle with these institutions. RBI took a significant measure towards unlocking of these idle funds by introducing bills rediscounting scheme in November 1970 as part of the new bill market scheme. The scheme permitted the banks to get the bills discounted by them, rediscounted from RBI. The bills rediscounted by RBI under the scheme were negotiable and marketable. The scheme was expected to impart flexibility to the money market, help in the evening out surpluses and deficits in the banking system, and thereby enable RBI to exercise an effective control over the money market. However, discounting and rediscounting of bills does not take off as expected by the central bank. To give a further boost to this segment, in November 1981, Reserve Bank of India permitted banks to rediscount the bills with one another as well as with approved financial institutions. November 1998 onwards, banks were permitted to rediscount all genuine bills arising out of sales of commercial vehicles discounted by non-banking finance companies. Later on, it was recommended to remove all the restrictions on the banks in rediscounting the bills discounted by non-banking finance companies, but with adequate safeguards in order to protect the bank's interest. Banks were advised to frame the eligibility criteria with the approval of their respective boards for such rediscounting in line with their credit policy. The bill rediscounting scheme was introduced to generate genuine trade bills in the money market and to even out liquidity within the banking system. The ultimate objective is to have a broad-based bill market with active participation of all financial and other institutions. Now let us come to the conclusion of this module. To sum up, we can say that the three money market instruments discussed in this module with commercial paper, certificate of deposit and commercial bill have a common feature of being easily transferable by endorsement and delivery. All of them are issued at discount to their maturity value. Credit rating is mandatory only for the commercial paper.